Well, hello everybody, and welcome to OpenMike. Once again, still from the open road. I'm on Cape Cod and therefore producing this myself, which means it's going to be rough, as it usually is, since this is not my area of expertise, but hopefully we can work through this together. Okay, so we have a couple things going on here. Tomorrow, Carnival Cruise is going to be reporting before the open. The options market right now implying a move of about 8%. That's significantly larger than the 5% that the company has historically averaged over the course of the last 10 plus years. A couple quick things about Carnival that I think are kind of interesting here from an options trading perspective, and actually from a valuation perspective as well. So, what I think investors are likely going to be focusing on is whether or not the company is looking to continue the robust bookings that we saw earlier this year. I believe I mentioned, maybe not last week, but certainly recently, that when I was taking a look at consumer discretionary stocks, one of the things I observed was that the consumer discretionary stocks that focused primarily on the more affordable entry-level types of segments were underperforming the more aspirational or luxury or higher end areas. That is definitely the case here. So, for example, Carnival Cruise had underperformed Royal Caribbean quite significantly. Carnival tends to focus more on the entry level, if we can call it that. However, their bookings have indeed remained fairly robust. So, are we going to see a problem where rising credit card balances, rising delinquencies, things of that nature, which, by the way, Goldman Sachs highlighted once again? I believe it was in a note this morning. At least I read it this morning. This is something we've discussed on the channel in prior videos. I think it still remains a pressure. But I think an important point to think about with Carnival Cruise is that at its current level, having underperformed as much as it did, and having had relatively good bookings so far, the multiple is really not that extreme. I think it was trading in the mid-teens in terms of its earnings multiple, and I think there is perhaps some value to be had there. Compelling value, I don't know about that, but some value to be had. Another point, they operated within the Baltimore harbor that was affected by the collapse of the bridge that was struck by the cargo ship, the Francis Scott Key Bridge in Baltimore. They have temporarily relocated those operations to, I believe, Norfolk, Virginia. And some estimates of the cost, which we will expect to see in this earnings result, was something in the neighborhood of $10 million or so. That's really not meaningful in the grand scheme of their operations. And in any event, I expect that investors are going to see past all of that. Now, one of the things that I think is also interesting about Carnival is this is a stock that paid a dividend historically. They unsurprisingly suspended that dividend at the beginning of the pandemic because their operations weren't merely disrupted, they were effectively discontinued. Capital intensive business, no revenues, you don't continue to pay a dividend. They did indicate that when things normalized, they would reinitiate that dividend. So I think the timing of that dividend starting up again is probably something that investors are going to be quite interested in. There's a couple things going on here, though, and they have implications for the prices of options. And they also actually have implications for the prices of options relative to each other, specifically calls versus puts. So let's just talk about the first one, which is the value of options generally. Before the pandemic, the company had, and I'm working from recollection, I do have a couple things here that I can go to. And by the way, I may be able to do a screen share with my Bloomberg on one of these laptops and an options play on another. And actually, I don't need to go exclusively by memory. I might as well just take a quick peek. I believe that they had debt of just under 12 billion for the period ended November 30th. There, it has to do with their fiscal year 2019. So that would have been just prior. Let me just double check that number. What was it? So actually, their total debt was, oh no, that's 2020. So let's see, 2019. I said 11, just under 12. It was 11.5. So $11.5 billion in total net debt. Actually, total debt. Net debt was 11 billion because they had about $500 million in cash on the balance sheet at the time. Enterprise value was about 42 billion. So as we think about how volatile the equity is when we're looking at a business, that has important implications for the price of options because options are priced off of volatility. The higher the volatility of equity, all else equal, the higher the price of options will be. So the current enterprise value is about $50 billion. So the total value of the business is greater now than it was at the tail end of 2019 pre-pandemic. The equity market capitalization, though, is about a third lower. So we're looking at $20.5 billion in current equity market capitalization versus $30.8 billion prior. So when you have this dynamic where, and oh, by the way, I should also mention current total debt levels are 32 billion and there's about $2.2 billion in cash on the balance sheet. So therefore, total net debt is going to be about 29.8 billion. So 29.8 billion of total debt on a $50 billion enterprise value versus 11 billion on a 42 billion in round numbers. What you would expect then is that the equity is going to be, give or take, twice as volatile, all else equal. And I'm not saying that it should be completely equal. There are implications for whether or not it should be more or less, but just strictly looking at the leverage that's applied to the equity on the balance sheet, it should be about twice as volatile. And actually, I think we will see that. I'm going to share my screen very quickly. And I'm just going to go back in time here, and we're going to take a look quickly at how volatile the stock was and how high the options premiums were in terms of implied volatility. And here's what we can see. So I'm just going to click these things off one at a time. So right now, what you're seeing in orange, this is the 60-day realized volatility expressed as an annual number. And you can see that at the end of 2019, we're right around in the low 20s. And where are we now? Sure enough, we're in the mid 40s. So about double, as we would expect, because the equity is about twice as levered now as it was then. Options premia, unsurprisingly, very similar numbers, 21 and change. We're now around 42, 3, 4. So again, just about double, as we would expect. Okay, so I bring this up because when we look at the history of the earnings-related moves, and we see that over a long time frame, going back to call it 2013, that the average move was 5%. Now we can take that 8% move that the market is currently implying and put that into the appropriate context, right? So what we can deduce from all of this is that the historical earnings-related moves are not necessarily applicable now that the company has a lot more leverage. There is something else related to this debt, other than its implications for the volatility of the equity, and that is that the fact that the company has this much debt, has more debt than equity, so close to $30 billion in debt, $20 billion in equity. So we can take a look at the fact that the company now has about 20% higher revenues than it did at that pre-pandemic time. So I think we were looking at about $20 billion versus $24 billion now. You inflation adjust that, that's actually a push. So I think that's an important consideration that, in many cases we look at these things, we say, wow, revenues are up 20%. Yeah, prices are up 20%. So that actually is not reflecting growth necessarily. That helps explain the fact that the multiple is not that high. The other implications, though, here are we've got EBITDA of about just under 1.8 billion. And I bring that up because when they were still paying a dividend, the last full year of dividend payments, I think, worked out to about 1.5 billion. So it would appear that the company is getting close to the point where they could potentially pay a dividend. but I do not believe that they're going to initiate one probably until they get that total debt level down or their debt to equity a little bit squared up. So I think it's worth considering that the dividend being reinstated is on the horizon. How quickly might they announce that? My guess, if I was in their position, I would probably push that off a little bit. But why this matters from an options trading perspective is because all else equal, dividends, as they rise, reduce the value of calls relative to puts. And the reason for that is pretty simple. If you are a stockholder, you are entitled, well, if you're a stockholder on the record date, prior to the ex-dividend date, you are entitled to the dividends, if any. As an options holder owning a call option on the stock, you do not get those dividends unless you first exercise the call, therefore have the stock and own the stock on the record date. So the call options and the put options reflect the forward price of the stock, excluding dividends and including other carried costs. And so to me, if I'm looking at this, I would suggest that for those who are interested in owning the stock, being in a covered call is probably the right way to go. So if and when the dividend does get reinstated, and I'm not saying that's going to be announced forthwith, I'm just saying that it's going to happen eventually. And if you are just always selling calls against stock that you own, the chances are that you're going to see whatever calls you happen to be short, assuming that they capture what would be a record and ex-dividend date, are going to be reduced by that quarterly dividend amount, give or take, the net present value of it. So I think that's a position that one might contemplate. And so what I can do is we can just take a quick peek here. And I can share this screen. Let me see, is that coming up? Yes. Okay. So we're just going to take a quick look. And I see that there was a question that came in about Uber. We're going to get to that. So Carnival Cruise, just taking a quick peek, just going into the app here, buying the stock and selling a call against it. I generally prefer to sell calls, of less than 45 days. I'm just going to go and use July regular way as the 1 for our example here. And so the 18 and a half, which are well out of the money and a very low likelihood of assignment, expire in 25 days. You'd collect about 23 cents for that. 23 cents doesn't sound like much, but against a stock that's less than $16.50, this is still $2 out of the money. Well inside of the implied move would be well inside of this strike, because we're looking at give or take, 8% move is what the options market is implying. Even if you got a 10% move, that would be $1.60. So that would take you up to that $18 level. So the probability that you sell these calls and they expire worthless is quite high. Problem is, of course, we are right now, as I speak to you, it is after hours. Because it is after hours and they report before the open, we are going to get this move probably on the open tomorrow. So why do I mention all of this to you now? Well, one of the things that we often talk about is that we're not usually that crazy in covered call situations about selling covered calls going into events if we don't think that the options are materially overpriced. And in this particular case, as we illustrated, so think about it this way. If you expect that the equity is going to be twice as volatile as it has been historically, and if the average earnings related move in its less levered state was, call it 4 or 5%, and we expect a similar move now, which I think would be entirely reasonable, then that 8% implied move is sort of on point. And so what's probably the right call then, if you own the stock, look to sell covered calls at some point tomorrow, later this week, and doing that recurrently. Or you could even purchase the stock with whatever new news we have out. I think it's going to be fairly revealing, and I'm actually kind of really interested in what management comments might be, simply because we are dealing with a situation where I'm curious about the impact on this socioeconomic demographic of consumers specifically. So I think that's an important one to look out for. So buy rights, covered calls, Carnival. I think the valuation is reasonable. It's obviously cheap compared to the S&P generally, and I think it deserves to be. But I think that's one we can take a look at. So also interesting, tomorrow after the close, we have Federal Express reporting earnings. I have spoken about Federal Express in the past. I personally have not had the greatest success trading the stock, sometimes just simply because of the way the stock performed. Other times, actually, we've actually had trading issues with it. So I always have a bad taste in my mouth about FedEx. But it is worth noting that here we are dealing with a stock that is actually, again, quite cheap. And the observation I would make, and the thing that I thought was kind of interesting when I was looking at it, is the stock gapped higher off the earnings that they reported in the third week of March of this year. So trading about 12 times earnings now. Gapped higher. Partially that was due to the earnings results that they announced, but also they basically outlined their stock buyback plan. Markets generally like stock buyback plans. They liked it in this case, and the stock traded higher. And what's interesting is that the stock is almost right back to the levels that it was. Let's see if we're going to get a look at my chart. So yes, you guys get to see my Bloomberg terminal once again. You can see that it's basically right back there. So I'll just annotate really quickly on the screen in case it's hard to make out. I apologize for that if it is. But right here was those March earnings. It's actually, look at this, it's actually trading a little bit below. It has seemingly returned, as my friend Carter Worth sometimes says, it has returned to the scene of the crime. Actually, you know what? I need to go back to that for a second because there's something important here. I'm not a technical analyst. Carter is. But something he often says is that the lines draw themselves. So in this case, we're just letting the machine do it. We can see that we've actually had a couple decent trading days, but that's not the thing I really want to point you to. Let's instead just zoom in on this a little bit. Get this right into the middle here. And we're going to ignore volume momentarily. But this is a very curious condition because we need the stock to stay in this area. If it does not, it certainly looks like the purple line here that I'm highlighting is moving towards the yellow line here. That's the 50-day and the 200-day. Do I care a lot about the 50-day? Do I care a lot about the 200-day? Not particularly, but there is a technical pattern that involves those two moving averages that people often allude to. And I know if it matters to them, then it should matter to everybody because people tend to respond to sort of these broadly held beliefs about technical indicators. A good example of this would be an upside reversal. Stock gaps open to a new all-time high, closes lowers on the dead lows for the trading day. Very bearish setup, whether I was trading commodities, whether I'm trading stocks. It's never a pattern you really like to see. When the 50 crosses the 200, that's the so-called death cross, and that's ominous. So I think it's important to keep an eye on that. For now, though, as we can see, it is above that level, so we haven't actually created that death cross yet. So there's, I think, two ways to play this that I would consider. And again, from the long side, somewhat reluctantly, given my history, but just the stock has outperformed UPS, by the way, by about 10% over the last 52 weeks. So they have a couple big, this is actually something I've neglected to mention. They have two big cost-cutting initiatives that they are currently involved in. And part of that is to contend with both something that is a secular tailwind, but also an operational challenge. And that is that, e-commerce continues to grow. The problem is that the e-commerce segment is a relatively low margin portion of their business compared to other areas. Obviously, they're under pressure from other transportation and logistics companies that occupy the space. Notably, Amazon obviously comes to mind. So the challenge that they have is to get costs down to a point where they can efficiently take advantage of that secular tailwind, because obviously if you don't have the margins, then you're not really in a great business. So they have two big cost-cutting initiatives. Collectively, they're supposed to represent, in the aggregate, about $6 billion in cost savings. Because the buyback was already mentioned and is therefore fully baked into investor expectations, effective with the third week of March of this year, that obviously is not going to present much of a tailwind, I wouldn't think now. People know about that. The pace of it, maybe they make new comments about that. But it's really these cost-cutting initiatives that I think people are going to be focusing on. So here also we have a well above average implied move. We do not have that same dynamic, though, necessarily, that I was referring to in the case of Carnival. The total debt level, I mean, they did take on some debt, obviously, in the beginning of the pandemic. Total debt level as of May 31st of 2020 was about the same. Net debt was about the same. Now, obviously, they had absorbed significant disruptions by that point. But like I say, I think that's kind of sort of fully baked into the cake. The enterprise value of the business, about $29 billion higher now than it was at that point. Again, very reasonable when we think about the fact that they've actually seen their revenues increase by more than 20%. So they have seen some real growth. We do want to see their margins get a little bit higher. Their 2019 margins were close to 6%. That was the total net margins. They're operating closer to 5% right now. So these cost-cutting initiatives that they have are really the name of the game for them. What would I propose then? Oh, and I've had you on, I apologize. I think I had you on, I had you on this the whole time. So sorry for that. But let's just take a peek. I think this is a situation that might set up okay for a poor man's covered call. A little bit more capital efficient than buying the stock, and also a little bit more hedged in the event that we get something truly disastrous. I've experienced the truly disastrous. That would be second half of 2022. FedEx was a holding of ours in the 40 Act fund, and they had their worst post-earnings price decline, I think, in like 30 plus years. But so let's take a look here. So I think what you could do is buy, and I was actually looking out to January of 2025, slightly in the money call option. I think I was looking at the in 250s, and then selling some upside Julys against it. I think I was looking at the 275s when I was looking at this earlier today. Now, unlike the Carnival situation, these guys report after the close. So if you are thinking about this one, these prices are not going to change materially from what we have right here. So, this is, I think, a way that one could consider playing FedEx, whether you're interested in doing it going into the print or thereafter. I think just the fact that the stock has actually traded back down. When I was looking at it, I was just glancing and I said, oh, it's roughly back to where it was pre-earnings last quarter, and turns out actually it's even a slight discount. So, and I think a lot of the things that they're dealing with, of course, they're going to be affected by economic issues. Everything will be. But the trend is their friend in terms of the business that they're in. So if they can just get that operating efficiency up a little bit, and bear in mind, I mean, there is another sort of margin of safety, if you will. It's priced as if they're going to achieve these gains very slowly, because it's trading at less than 13 times forward earnings right now. So, which strikes me as reasonable. So whether you decide to do this ahead of earnings, which is riskier, but you will be able to squeeze a little bit more out of the near dated options you sell, or wait until afterwards and we get sort of more clarity. By the way, if you wait until after, then we're going to know more definitively whether or not that death cross of the 50 crossing below the 200 is actually in play. Okay, so I'm not showing that trade anymore. Let me make one other comment here. I'm going to be talking about this. I might as well. I'm going to be talking about it on Fast Money in just a little bit. So Chipotle announced a substantial stock split, 50 for 1. So let's just talk very quickly about what the implications are for the options for those of you who don't know. Pretty straightforward whenever there's a stock split, particularly if the stock split is in a denomination that easily permits round lots of stock. What's a round lot? 100 shares. How much does the average options contract, how much do they typically represent? 100 shares. So if you have a 2-for-1 stock split, that's very easy. Whatever one contract represented 100 shares, now you can have just multiply the contract quantity by 2. Each new contract represents 100 shares. So the way that would work is they divide the strike by the split amount, and they multiply the contract by the split amount. So if you had 100 strike call in a $100 stock pre-split, splits 2 for 1. Now you have 50 strike calls, each for 100 shares. The premium that you hold, that you either are long if you own them or are short if you are short them, it shouldn't change that much. Could it change a little bit because of minor changes in implied volatility? It's possible, but it's not going to be meaningful most of the time. The exception to this is when you have splits that don't work out so neatly. What would be an example of something like that? A stock splits 1.5 for 1. So where you had 100 shares, now you're going to have 150. Well, that gets a lot clunkier, and what that usually results in is sort of a customized. They adjust the contract, and suddenly you're going to have a contract where you divide the strike by 1.5, and you multiply the quantity. So now you have a contract that represents 150 shares. That's not the case in Chipotle. Chipotle is very straightforward: 50 for 1 stock split. What that means is all of those strikes are going to get divided by 50, and all of the contracts are going to get multiplied by 50. So if you had stocks around $3,200, you can imagine that if you had the 3,000 strike puts, you are not going to have an odd lot contract. You have one put. Now you're going to own 50, and instead of the 3,000 strike, it's going to be 60. 3,000 divided by 50 is 60. So that's how you come up with that number. Probably most of you already know that. If you didn't, that's how it works. One other quick point, and that is that in these cases, usually you'll see a huge uptick, of course, in the number of contracts traded. That's not a big surprise because, first of all, you have all of the existing open interest is multiplied by 50. So there's just a lot more contracts where people hold them that they're going to be trading into and out of. Although the notional amount on a relative basis will sometimes drop. And why is that? I'm going to speculate and suggest that it has to do with the fact that as the share price comes down, there may have been people who are using options as a way to gain exposure to the stock with a smaller capital amount. Now that the share price is reduced, perhaps they'll do less of that, and just trade the shares themselves. I'm not 100% sure why, because of course, usually that's not a problem. You just trade fewer shares. There's no rule that says you must trade a round lot of stock. You don't have to trade $320,000 worth of Chipotle, which is a round lot. If you don't want to, you can trade 10 shares. You can trade one share for $3,200. Okay, so that is that. And let me just take a quick question here. Ranjana Gupta, welcome back, Ranjana. Which of the, and by the way, because I'm just doing this myself, I can't put it on the screen, which is what I would like to do. And also it's going to start heating up in here. So the air conditioning in this house works most effectively on the first level. So there's actually window units in the room that I'm in, but we turn that off because the thing makes a heck of a racket. Okay, and now I've got my dog barking. So hopefully she will go downstairs and, hey, Sophie, you want to say hello to everybody? This is Sophie the dog, and she's barking, and hopefully somebody downstairs will hear that. And she's actually a very big dog, 100 pounds, but you can't, go downstairs, Sophie. Sweet dog, sometimes a guard dog. Okay, with Uber, and I'm going to pull up on my screen here. The question is, which of the following strategies would you use on Uber right now? Selling a cash secured put, a strategy I generally like, kind of like a buy right. Buying a poor man's covered call, strategy I also like. Or writing a call spread risk reversal. Writing a call spread risk reversal. Okay, so